That's live there.
We're live. Good evening. We'll be in just a moment, just making sure everything's working. Let me know you can hear me okay. Just pop a question in the comment section below if you can hear me okay. We'll get started in just a moment. So, okay, I think we're good. So good evening and welcome to this live Q&A with myself, Saj, Hussain, asking anything about property. Over the next 30 minutes or so, I'm going to use my time, skill and experience to help you and guide you whichever way I possibly can to help you get further faster in your property investing journey. So these sessions are really me giving time to you to help you. They'll probably be a bit useless if I don't get any questions. So make sure you put some questions in the comment section, regardless of which platform you're watching on. So we're live on Facebook, LinkedIn, YouTube, Instagram, Twitter. We're live on all these platforms right now, unless, of course, you're watching this as a recording, in which case it might not be live. But right now, we're live. So pop a question in the comment section below, and let me see what I can do to help you with those. And just to get started, I've got some questions left over from last week, which I'll start answering first of all. I've got a few of those, and then we'll jump onto the questions that are coming through live. So don't leave it to the very end. If you want your question answered, particularly here today, get it put into the comment section below, and I'll do my very best to get that answered for you. So just grab the first one. I've just printed these out. So the first question is from Andreas on LinkedIn. And his question is, I would like to ask, people are taking a loan in order to make their start in the housing investing. What do you think about this? Should someone take a mortgage in order to invest, or should they go through REITs? So first of all, let's just clarify. I've got a feeling this person may not be in the UK. REITs are real estate investment trusts, which are much more common in America and some other countries as well, less so here. They're affecting general ordinary property investing, not really the kind of things that we tend to talk about or get involved very much. But let's just talk about the principle of the question, which is whether you should take a loan to get started in property. Ultimately, the way I would think about it is about a return on investment. Now, when we're investing in property, we're putting a certain amount of money in order to get a certain amount of return, to build up the capital over time as well there, and also to potentially get an income from that property. So you look at how much money is going in versus what return are you getting. So I'm a big fan of using other people's money, using leverage when you're building a property business and a property portfolio, which is essentially how I built my business. But when we're talking about borrowing money, it's essentially somebody else's money. But I think specifically Andreas here mentioned taking on a mortgage to start investing in property. Well, when you're taking on a mortgage, effectively you're borrowing money against a property. So I'm not sure I fully understand your question, Andreas, but if what you're asking is borrowing money to invest in property, I think it all depends on the return on investment. I would make sure you minimize the risk as much as you possibly can to ensure that what you're doing is able to return the funds for where they've come from with the additional profit or interest or whatever you've agreed with that particular source, be it an investor, be a traditional lender, mortgage, or whatever it may be. What I'm not such a big fan of getting into debt to be able to maybe learn. And sometimes people talk about borrowing money to be able to start learning about and investing on training. I think you should be doing that if you have the funds available. I'm not a big fan of going out and getting into debt to be able to start learning about property. I'm not saying it doesn't work, but I think you'll be in a safer and stronger position if you have some funds available when you get started in property. But people talk about you can buy property, no money down, you can buy houses with little money. You absolutely can. But you know, if you're doing that with no money whatsoever, you're leaving yourself vulnerable. You're going to still need some money for solicitors and other costs as well. So it's important you have access to some money around you. So Andreas, I hope that answers your question. So if I just jump on to the next question, Khalid. What we've got. So this is from Damien. Damien on LinkedIn. What's the best way to find an investor partner? So a nice flow on to what we were talking about before. So Damien's question about finding somebody that might invest with you in property. So ultimately, it's thinking about why is it that somebody would invest their hard-earned cash in you? Why would they do that? Well, the reason they're going to do that is because they get to know you, they like you, they trust you, and they believe you can deliver a return on their money. Your job is to make sure you can deliver that return safely, deliver the return and the capital back to them. Now, when you're looking for somebody to invest with, there's a couple of different ways you can do that. You can either go out and offer opportunities and see who comes to want to work with you, or it is you can allow people to come to you rather than you kind of reaching out to them. So what does it mean? What am I talking about when I'm saying this? Well, essentially, my view is, if you're on one of the reasons I do these videos as well and other videos on social media, is I'm sharing what I'm up to and what type of deals I'm doing, what type of projects I'm doing. And some people reach out, they want help in terms of mentoring and training. Other people might reach out because they're looking to maybe get involved and invest with me, and we can have a conversation around that. So see there, what happens is people will gravitate towards you because they see something about you that they like, they want to get to know you, and if they feel they can trust you, that might move forward into a potential investor relationship. So this is my preference in terms of raising investment. Excuse the background noise there. We're on the offices on the high street there, so it's a busy main road, even though it's late in the evening. So thinking about why is it somebody's going to invest with you, and what is it that they're going to get from investing with you? Now, sometimes people will reach out to you because they hear they can get some great returns. But often I'd say those are potentially not the best people to want to invest with because they're focused on numbers. I think it's much more important to take the time to build a relationship with people. So the easiest place to start with is people that already know you. Because when we talk about know, like, and trust, they already know you. So who already knows you? Friends, family, neighbors, work colleagues, people you might have a relationship on social media, which kind of your wider friends network. So people that already know you, it's much easier to be working with them than somebody completely out of the blue. So I was doing a mentoring call last week with somebody who wanted to raise quite a lot of money, and we were having this conversation. I said, look, the reality is somebody out the blue isn't going to reach out to you and say, hey, I want to invest a large sum of money with you because it looks like you've got a great deal here. It's often the case that they might test you with a small amount of investment just to see how that works. Are you going to deliver on what you say you're going to do before they start having a conversation that's a little bit wider around more money. So it's about proving what you're doing. So in summary, it's really about sharing what you're up to, what type of projects you're doing or you're looking to do, and start the conversation, understand why somebody might want to invest with you, what's most important for them in wanting to invest with you, what expectation they have around that, and then for you to decide, is that something you can deliver, so you can explore the conversation a little bit further. And just before we move on from that question, remember there's some rules, FCA guidelines as well in terms of raising money. So if you're looking for joint ventures, really you need to be reading the document PS13/3. You can Google that on the FCA website and download it and have a read. Or if you're looking to borrow money in terms of a loan, those rules don't apply in the same way. So look, I hope that's useful. Damien, let's get the next question on here. Remember, if you want your question answered, it's important that you put it in the comment section, whichever platform you're watching on, whether it's Facebook, LinkedIn, YouTube, Twitter, Instagram, and then I'll do my very best to answer those questions for you. And also next week, I'll be running a webinar. So rather than doing this traditional live Q&A, I'll be doing a much more detailed strategy training session, really about getting started, what I believe are the 3 best strategies. And I'll flash up some details onto the slides a little bit later on in terms of the address for you on that. So the next question is from YouTube, Nation Banzai. I'm guessing that might not be your real name, but that's the handle that we've got. What do you think about the BBC documentary about unregulated property training sector? So this is a question really about a documentary that was recently, if I'm being honest, I haven't watched all of it. I've watched a shorter version of it, but I get the sense of what it's about. And the reality is, if somebody is delivering training, well, let me actually put this a slightly different way. So I've invested a huge amount of money in my own personal development, in my knowledge, in my training around property, well over £100,000 in terms of my development over the last several years. Now, some of it has been absolutely fantastic and made a huge difference in terms of my business and growing and kind of getting me to where I am today. And some of it has been, not so great. And some trainers and mentors have been phenomenal in their support, and some have been brilliant at selling me into the idea of working with them, but maybe not really delivered on the other end in terms of their support. So really, it's important when we're looking to get training and mentoring that you get that from somebody who's already done the things that you want to do. Personally, I think that's so important. So look, if somebody comes to me and starts talking about building commercial units because they want to find Tesco's as a client, I'll put my hand up and say, look, I haven't done that. I don't have experience with that. The great thing is I have a huge network of people, and I can usually get in touch with somebody that does do that. And in fact, I do have a friend that does specifically those things, but I have no experience with that. So I'm not going to be teaching people how to do that because, I don't have that experience, and I think it's unethical to do that. But there are many people that don't actually do the things that they teach. So they teach what you should be doing as opposed to what they're actually doing themselves. For me, I believe when I'm sharing my knowledge and my experience, I'm teaching, I'm training, I'm mentoring, what I'm doing is sharing my actual experience and things that I'm doing. I'm very active in terms of investing in property. I mean, right now we've got 7 projects that we're running, various different ones from flips, commercial to residential, a number of HMO ones, building new houses, and I can share that experience of what we're doing. The question about whether the training and mentoring sector should be regulated, I think that's a good thing. I think it'll probably get rid of a lot of people that probably haven't really got the experience out there. But I think it's also important as us as individuals that are looking to take on mentoring and training, that we take some responsibility about researching who it is that we might be asking for some assistance with, and see that they've got the ability to be able to help us and support us, and the capacity as well. Personally, I think I learn a lot better in a smaller group of people rather than a huge rooms. In fact, I run my mentoring tends to be a lot more smaller groups as well. The mentoring groups are 15 people, and maybe that's because the way I learn better, and I kind of share that the same way. And a lot of the mentoring tends to be around specifics and making the difference and nitty-gritty detail as opposed to high-level stuff. And that's just been my experience of the way I work. So hopefully that's given you my thoughts on that. Nation Banzai, thank you for the question. I think I've got one more on here, and then I'll take the ones that are coming through now. Please, if you want your question answered, ensure you put it in the comment section so I can answer that for you. So the next question I've got on here, these are the ones that were left over from last week that I'm still doing, is Abdul Khalik Mustafa on YouTube. How to deal with a tenant who break the tenant agreement. I think essentially what you're asking is a tenant that's in breach of their tenancy agreement. How do you deal with them? That might be they want to leave early. There might be they're not paying the rent. It might be that they're not sticking to the terms of how the property should be used, i.e. the type of use as well. Now, in short, tenants have a huge amount of rights, and you can't just go in waving your finger about, no, you can't be doing this, and this has got to stop, and you're going to need to leave the property. And we can't do any of those things. They would all be outside the scope of what we can do as landlords and managing agents. So I'm speaking both as landlord and also as an agency that manages literally hundreds and hundreds of rooms in Birmingham. So it's really important that first of all we look to try and understand what's gone wrong here. If we take a step back from that, personally I think it's really important to take the time to vet who we let to in the first place. And by that what I mean is, if a tenant, for example, is in a situation they're not paying rent, did we do everything we possibly can up front to vet their ability to be able to pay the rent? Have we looked at their income? Have we looked at historically, have they had consistent income at the same level? How long have they been at that job? Are they in the probationary period? Are they been doing that something for quite a long time? And these are the kind of things we need to understand before we even move people in. So thorough vetting, I think, is really important. Then secondly, when something goes wrong, I think the communication aspect of having speaking to, reaching out to the tenant to understand what's gone wrong or what might not be working. And it's really important that we do that very early, or as soon as we sense things may not be right. And often when you hear the horror stories of cannabis farms or a tenant owes £15,000 in rent and all these kind of crazy things that we hear about, these things happen because the landlord or the agent has let things slip and slip and slip and get to that point. So we need to prevent that from happening. So if a tenant's going to raise, we need to try and reach out now. Here's the thing. Sometimes you'll get tenants that are deliberately going to be really difficult. They've got no intention of paying. They can slip through the net. That can happen. But I'm talking about, generally speaking, the vast majority of tenants that might be breach of some kind of tenancy, agreement that you have, you need to reach out and understand what's going wrong, or what can you do to rectify that. And if things look like they're not working, you serve a Section 21 notice, which currently still exists, may disappear soon, where you can give 2 months notice to leave the property, and that you don't need to specify any specific grounds right now. You can just be, I want the property back. This is if they're outside of their minimum 6-month contract period. Or you can give a Section 8, which is based on, there's a number of reasons why you're looking to end that tenancy. Could be, for example, persistent rent arrears, it tends to be the most common one. And that could be within the 6-month period as well that you can actually do that. And now there's a course of things you've got to go through in terms of being able to get possession of the property. It's not so straightforward as serving that document, get the property back. And in fact, I've done a couple of videos around that. If you have a look on my YouTube channel, I'll talk about getting possession of the property and the process you need to go through. So really, it's communicating with the tenant and trying to work with them and help them to do what you can to get them out results. So for example, if somebody's just lost their job and they're sticking their head in the ground and they're avoiding you and they are not able to pay the rent, if they're genuinely unable to pay the rent, it may be that they're entitled to housing, some kind of housing support from the council. So you want to make sure you're reaching out to them and talk to them about that, and maybe even helping them with the application to get that done. So really the key here is communication, because if you're relying on any kind of brute force, firstly, that'll be illegal and you're going to end getting yourself locked up. And if you're relying on the legal system, it's very slow, cumbersome, and exceptionally painful for landlords, because in my view, it's heavily in the favor of tenants and it's unbalanced when it comes to landlords and managing agents. So that's my view. Hopefully you find that useful. As I said, next Monday, what I'll be doing is running a webinar, and I'll get a link to the webinar in a short while flashed up to me. Thank you very much. So if you want to register for the webinar next Monday, it's sajhussain.com/startup webinar. Nice and easy. So that's a webinar next week that I'll be doing instead of this regular live session that I do, where I'll be talking about the 3 most common strategies I think people should be using if they're starting out in property, particularly in this market right now in 2020, the best things to be using. So let's grab the next questions. In fact, there's the details. We'll leave that up for a moment while I do the next question. Can we go back to that slide and leave that up for a short while? So this question is from Khalid from sunny Edinburgh. So why am I smiling here? Because there's a Khalid that works with me who's also from Scotland, from Edinburgh, and I'm wondering whether he's just thrown this here as a curveball. Is that I love watching your videos. They are great value. Do some of your advice work in Scotland? Great question. In principle, what I talk about, absolutely it will work in Scotland. However, the legal system is different. So it's important to understand how those things translate. And I don't invest in Scotland, so I can't give you the advice and say, look, this is what you need to do and this is how you need to do it. But in principle, the idea of, for example, motivated sellers, buying below market value, flipping properties, adding value, creating multiple occupation in properties, splitting properties into multiple units. In the principle, all these things are the same. It doesn't matter where you are, because these are techniques and methods you can use to create money from property. However, the legal system, as I said, is slightly different in Scotland, so it's really important that you understand how that works locally. I can't give you that advice because I don't have the experience of working in Scotland in property. So thank you for that. Whether that was a real Khalid or whether that was Khalid that works with me, I'm not entirely sure. So next question is from LinkedIn. This is Amajit. Can you get a higher return? Can we flash these up on the screen or we can't? Okay. So can you get a higher return renting out via Airbnb compared to traditional method of renting a property? So Amajit, your question is essentially is if you're using one of the short stay platforms such as booking.com or Airbnb, can you make more money from that versus, let's say, letting your house out to a family, a regular couple, or whatever it might be? In short, the answer is yes, but it's important to understand what that means. Now, when you're doing a single let property, often the tenant moves in and you don't hear very much from them. They pay you rent every month, you do periodic inspection, and you do make sure the property is compliant, gas certificates, etc., and everything is good. And you'll make a reasonable return. What is a reasonable return? Everyone has a different opinion. People talk about 6%, 8%, 10%, whatever it might be, return on the investment. Now, when you say step up a level and go into shared accommodation or HMOs, essentially, which is a lot of what I tend to do, there's a huge amount more work that needs to be done. There's a lot more setup, there's a lot more work, there's a lot more hands-on activity, there's a lot more changeover of tenants coming, going, more viewings, more inspections. There's just so much more work to be done. But the good news is there's so much more money that can be made from HMOs that can be from a traditional single let. Now, if you want to step it up a little bit more, then you can increase your income once again from properties like short stay properties where you're using Airbnb or Booking.com, whereas instead of people paying rent for staying in the property for 6 months, effectively you're almost letting it per night, a little bit like what they would do in a hotel where you're staying for a night, 3 nights, 5 nights, a week, or whatever it might be. So they're much more short stays, and because the stays are shorter, you're charging a higher amount. And because you're almost letting per night, you have to take into consideration a number of other factors. First and foremost, you are not going to get 100% occupancy. So if somebody moves into your property in terms of a HMO, let's say a family let, they do a 6-month contract, that means they're there for 6 months. And if it's a HMO, you let one of the rooms, a 6-month contract, they're there for 6 months. It might be you haven't got all the 6 rooms let simultaneously, but your occupancy may be a little bit lower than what it might be if it was a family. But then when you go to service accommodation, it would drop further. What I mean by that is there'll be a number of nights each month that the property will be unoccupied, most probably when you do short stays. And the range of that can be anything from 20 to 30% even. For us, it tends to be about 15 to 20%. I'd say we're quite good and fairly efficient at keeping the rooms, the studios, the properties occupied in this way. But it involves much more work than, for example, HMOs do. And some of these, as you start creating some scale, you can put some systems or processes in place and other people to help grow that, which is essentially what we did with the HMO business and now what we're also doing for the short stay service accommodation business. So firstly, you need to do some research rather than just assuming that's something that will just work because we're making some assumptions here. So looking at the local market, is there demand? So look on these platforms, Airbnb, Booking.com, and a number of other platforms as well, to see are there other properties available in the area that you're thinking about operating in, and what kind of rate are they charging? What's the quality of the accommodation like? Just to get a sense for the market. And also, the other thing you can do is look at hotels. What hotels are in the area? What they're charging? Because to some extent, they're your competition, because they're also the alternative into come and staying with you for a short period of time, for a week or so. They could rent a room in a hotel for a week or so. And what's that going to work out as an alternative? So these are some of the bits of research that you want to do just to make sure that actually a market exists and what type of market it is and what rates it is. Because the reality is you're creating a product and taking it to market. And before you take that product to market, you just want to be really sure that there is a demand for that product. So, for instance, you may have heard me talk about this before, but if you've got a hotel, say a Premier Inn that you go and stay, you might spend £40 to stay in a Premier Inn hotel for the night, but you might go to a Holiday Inn, a much nicer one, that may be £140 for the night. What's the difference? They're both a room in a hotel for the night, but they're positioned differently, they're different products, they're placed in the marketplace differently. In the same way, you have to think about your product going into the market, who's it for, what type of customer, what they're willing to pay, and what is it that they expect to find in the way of accommodation. And then you do the numbers, you crunch it up, and of course you've got to think about changeover costs for bedding and linen change, and anything else you might be providing, and cleaning and things as well, because these are all costs you're going to incur which you wouldn't have incurred ordinarily in a family house. So I hope that's useful. Amajit, I hope that's answered your question for you. So I'll take another one here, see how we're doing for time. We've got about another 5 minutes. So this one is also on LinkedIn from Sukhdev in Greystone Letting. Hi Saj, is it worth keeping internet only or change interest only? Somebody's terrible handwriting. His mother wanted him to be a doctor, and as far as he got was the handwriting, got no further. I apologize, that was a terrible joke, especially if you're a doctor. So let's run the question again. So, hi Saj, is it worth keeping interest only or change to repayment? This is a great question. First of all, let me just clarify that I'm not a mortgage advisor and I can't give financial advice. What I can do is share with you my experience and my knowledge and my viewpoint, which is essentially what I'll do. Now, when we're letting properties and we're keeping investment properties for the long term, essentially, we're either looking to create capital for the long term or income right now, income today. So income today would be from, say, rental profit, and capital in the long term would be the increase in value over time, whether you remortgage that or whether you sell the property and extract that out. And ideally a balance of the two, depending on where you are in the country and the location and what's happening in the micro market where you're based. But the core reason many people have got involved in properties to create the rental income. And of course, with the likes of Section 24 that's happened, that's had a huge impact. And if you're not sure what that is, it's about offsetting your interest costs as a cost against your income. So what tax you're paying is based on your true profit. That's now changed. So putting that aside for the moment, let's say your property is generating, say, £500 of rent a month. Just keep it nice and simple. And your mortgage is £300 a month. So that means you've got roughly £200 profit. Of course, you've got other costs like management, maintenance, voids, and things to think about. But on a generic level, let's say you've got about £200 profit. So your £300 is your interest-only part of your mortgage. Effectively, all you're doing is servicing the interest element of your mortgage debt over a period of time, 10 years, 15 years, 20 years, whatever it might be. At the end of that mortgage period, you will still owe the same amount of money because all you've done is pay the interest each month. Now, one viewpoint is because you've been making a profit as you go along, that's been your benefit, you still owe the debt at the end of the mortgage term. Now, hopefully, and there's no guarantee in this, but hopefully during that time, the house price has gone up as well. When we look at historically, the property market moves in cycles, and there'll be kind of peaks and troughs, but generally there's an upward trend in property prices. So the property will be worth significantly more. So you could sell the property, take on that chunk of profit at the end, plus the profit you made during the time, and hey, that's what you've earned from that transaction over that period of time. Alternatively, let's say the prices hadn't gone up, you could always sell the property at the end of it, and you've still made the profit during that time, i.e. your rental income. So which is why and how most people invest. Now, another way to think about it is you pay down the debt. So at the end of the term, you've actually not got any debt left on the property. So it's a 20-year mortgage, you pay your interest plus a bit of capital each month, and over a period of time, you pay down the debt. So at the end of 20 years, you've got no debt left on that property. And that could be a very good idea as well. The biggest challenge around that is, first of all, tax. That's a very inefficient way in terms of approaching taxation, because you can't offset your capital payments from your as an expense. So you're foregoing your income to repay the debt. And as your debt's building, your effectively your profit is growing. At the end of it, when you got no borrowing of that property, all that income will be taxable. So it's a little bit more to it than that, but in a nutshell, it's tax inefficient. It's not very efficient way looking at tax when you're repaying capital. The other thing also is if you're investing because you want to try and create an income right now, and we talked about £500 of rent and £300 coming in, and if you're doing a repayment mortgage, that might be, say, £450 at a guess. So your £200 profit is now shrunk down to £50 because actually you're using some of the money to pay down the debt as well. So you're not earning the income right now, and that might work for some people because they don't need the income right now, they just want to build the capital. But those are a couple of factors to think about, and as I said earlier, I'm not a financial advisor, so speak to a good financial advisor, mortgage broker. They should be able to give you a bit more indication on that. So look, hopefully you found that useful. How we're doing for time? We're kind of half-hour point. So questions I haven't been able to answer, I'll do my very best to answer those at the next session that we have. However, next Monday we'll be doing something a little bit different. I'll be running a webinar. There's a link to the webinar, and in that webinar I'll be focusing on getting started in property and my 3 favorite strategies in terms of building cash flow, building income right now if you're starting out in property. Particularly with the market the way it is, and what I think are the opportunities in 2020. So look, make sure you book yourself onto that webinar, and I look forward to seeing you on that next Monday. And then the following Monday, we'll get back to normal and start doing these. And any questions that I don't answer, I'll answer them then. But make sure you put the comments in the comment section on whatever platform you're watching on, whether it's YouTube, Facebook, LinkedIn, Instagram, Twitter, and I'll do my very best to pick up those and get those answered for you. And of course, we run our monthly meeting. And if you're watching this live, our next monthly meeting is tomorrow. It's the 3rd Tuesday of the month. We have about 100 people there every month. We're already sold out for tomorrow. Now you can book on to March's meeting using the usual link, which is sajhussain.com/networking. Once again, thank you so much and look forward to seeing you again very soon.